Okay, we're going to look at three things today. One, I just want to look at the market itself without looking at price. So this is going to be interesting. I want to show you a price chart without any price on it. And I want you to ask the chart when you look at it, what direction it's accelerating in. The other thing I want to do is I want to quickly visit back to the 2008 global financial crisis and show you all of the rallies, the way that the market got people back in to lose even more money. And we're going to do the same thing with 2000. So we have a lot to cover and it's going to be good. So stick around. Hey everybody, this is RC Peck, and this is my weekly update with Fearless Wealth. So what I'm gonna do is I wanna jump right over to the price charts and let's just talk about what is going on, but I'm gonna do it without showing price. Now there's three things you're gonna get from this video. One, looking at price and just really understanding whether it's accelerating or decelerating and what direction it's going. No one talks about this. That's number one. Number two, to review what's happened before. We have two crashes, two corrections we can go back to. Depending on how you measure them, the NASDAQ fell 83% in the first one, NASDAQ 100, and in the second one, it fell 55%. For the S&P, the first one was the Dotcom, fell 50%, and the second one, it fell 60%. So let's get to those. Let me move over to the price chart. So look at the screen here. I love this. I took price off, and these are just moving averages. That's all I'm showing you on here are just moving averages of the S&P 500 over the last 3.5 years. Now these moving averages move anywhere between a 20-day moving average all the way up to a 200-day. And the orange one, which is the 20-day, that's the fastest one, meaning that's the one that's closest to the price chart. So you can see that the 20-day stopped moving up at the beginning of the year, and most of these moving averages started to turn over. They started to move down. They weren't trending higher anymore. And finally, the last one, the slowest one or the biggest one, the 200-day moving averages has turned down. So the nice thing about looking at the moving averages is you can really start to see the direction that the market is going and whether it's decelerating or accelerating. And pretty much all the moving averages now are below the 200-day moving average, right? That's not good if you want the market to move higher. The other thing is just notice it's like this slow roll. It's a slow roll, and it's only accelerating to the downside. So you can clearly see that equities have rolled over and they are now, trending down. And this is a key thing because people aren't taught to think with their eyes. They're taught to read articles and trust people. And so we can clearly see something different or something has changed in the markets and it has not changed back. And you can do this we'll do it with all the major asset classes. Here's the bond market right here. So you can see even before this year, you had this whole kind of 18-month period where bonds stopped going up. By the way, here's the COVID crash right here. Bonds did go higher after COVID. They just could not sustain their price, and now they're just in a free fall. I believe they've changed direction. I believe they're now in a 35-year bear market in price, which has happened before. And then lastly, the last major asset class, this is commodities. Again, you can see just the opposite. Here it was flat going into the COVID. COVID absolutely broke it down. But since the bottom of COVID, commodities have been a very strong place to be. And they've been trending higher for over 2 years. The more they trend, the more they will trend. How about that? Okay, so here is the 2008 global financial crisis, just showing it through the S&P 500 with dividends reinvested, ticker symbol SPY. So what I want you to get from this is it wasn't a smooth line, right? The peak was actually here in October of 2007. No one was thinking about a 58% fall, crash with, drawdown. But what I want you to kind of notice, there's these periods where the market actually looked like it was okay, right? So it kind of did, you could call this a double bottom. And then the market went up 12%. And you're like, well, 12% is not that much. But considering from there, before it went up 12%, it fell 18 and then went up 12%. So this right there was a place where the market would have pulled more people and like, oh, that's it. We're just getting over it. And did a huge leg down, had a little bit, let's just call this a little relief rally. But things then start to get interesting when the market really falls apart, right? You have this big relief rally, whatever you want to call it, a big move higher, right? And those are starting to get pretty big here, right? So that's up 25%. The reason I wanted to show this to you, here, let's just make this look nicer. The reason I wanted to show this to you is it's not this straight line down, right? It's this, it falls, it goes up, pulls more people in, falls below, goes up, pulls more people in, falls down again. And this is what we're seeing today. So this was the 2008, and it's nice to visit past falls so you can understand, because really what you're looking at is the psychology of 400 or 500 million people and how they handled the global financial crisis. And you can see it was a very slow downtrending event until it wasn't, right? So before things really started to get crazy, it was just kind of trending down, and it was just about a 25% correction to the downside. And then something broke, right? In this case, what broke was Lehman Brothers. And then basically the market fell another 30 percentage points. Most people thought this was the bottom. I think even Warren Buffett came out and said, back up the truck or something like that, or America's great, buy America. And, it clearly helped because the market went up 25%. But then you had this to this, which was the final clean out. So the takeaway is just you have to really understand the direction, and you have to have a strategy. And most people do not have a strategy that they're conscious about. Okay, and then I wanted to show you the 2000 correction. It looked different. For one thing, it might not be obvious, but it is a lot longer. The market actually peaked way over here in March of 2000. Now, this is the S&P, but notice the S&P did not start falling, or it didn't stop going up way here until August, September. Let's just call it September 1st. This is important because on the NASDAQ 100, it stopped going up in March. So you had the NASDAQ 100 fully falling for 6 months before the S&P even started to recognize something was wrong. And it kind of had a triple top too. So, but what you have here is a market that fell for 30 months. The global financial crisis fell for 18. These rallies were much bigger, probably because the fall was much longer. And here's what's interesting to me. The fall was only 50%, but it didn't take twice as long. It only took 30 months, or it took 30 months and not 18. I think the longer the fall, the more painful it is. But you have these rallies where people are like, okay, it's over. Okay, it's over. And then it happens again. Okay, I guess it's over. And these are really big rallies here. So that rally right there, that's 19% right there. This rally right here was 20%. Those are two big rallies. And then you come down here. This rally, let's just see what this rally was. This one was another 21%. This one is 20. So let's just think about this. There's 4 times in the Dotcom where the S&P rallied 20%. 4 times before we actually knew it bottomed. And this is important. And this is what I wanted to really just kind of communicate to everyone today. There's a couple main points I wanted to communicate. If you don't have a specific logic-based, price-based approach, you're really stuck with headlines and gut feelings. And everyone has a gut feeling that worked out once. Everyone has one. I knew to buy gold in X, or I knew to sell, the NASDAQ in Y. Like, everyone has one case where their gut worked. And that's the one they remember. But with investing, what you really want is a price-based approach, because ultimately your portfolio is only going to go up when the price goes up, not when value gets to become deep value or deeper value, or when the PE ratio goes from 30 to 20, right? Because PE ratios don't pay the bills. Price going up does. And so just what I showed you this week is just really understanding that if you have a price-based approach, then you can just really get, oh, price isn't going up right now. Right now, price has been down for 6 months. It can be another 12 months. It can be 9 months. It doesn't have to be an 18-month or 30-month peak to trough. But those are the last 2 times the market did a full correction. Call it what you want, a correction, a crash, a wipeout. Those both happened in the 2000s. And were in some similarities between then, some dissimilarities. But the point is to not predict. Now, I talked about where the market can go. I talked about that in last week's video. Maybe that's a prediction. I'm fine if it's not. I'm simply pointing out in some of these videos where they can go. What I mean by prediction is, predicting, oh, it's going to go up, so I'll stay in. Or, oh, Trump got elected, I'm all out. I'm in cash because of some news thing. That, to me, that's predicting. But looking at where price you believe wants to go, that's very different. And so that's what I really wanted to show you today, just showing you the 2000 correction and the 2008 correction, and then showing you those first set of price charts that is just moving averages and nothing else. Let me know what you liked. Let me know what you didn't like. Hit the like button. Leave a comment. All these things matter. I appreciate you being in my world. And if you like this video, you'll like our other ones. And if you want to talk about, or if you're like, what's he talking about with those price targets? Last week, I talked about price targets for both the S&P 500 and the NASDAQ 100. So that was just last week's video if you want to go check that out. Thank you for being in my world. I appreciate you, and I look forward to seeing you on the next video. Okay, thanks.